Most beginner investors lose money in their first year, not because the market crashed, because they made one simple mistake. They tried to pick individual stocks instead of building a foundation. They chased hot tips. They panic sold when things dipped. They traded based on emotions instead of strategy. If you're just starting out, there's a smarter way. Let me show you how to invest like the wealthy do, without the risk of losing everything. The biggest mistake beginners make is thinking investing is about picking the next Amazon or Tesla. It's not. Investing is about consistency, diversification, and time. The wealthy don't gamble on individual stocks. They build portfolios that grow steadily over decades. And you can do the same thing starting with as little as $100. Here's what most people get wrong. They open a brokerage account, see all these stock symbols, and think they need to pick winners. So they buy whatever's trending on social media. GameStop, AMC, Dogecoin, and sometimes they get lucky. But more often, they lose money because they're trading on hype, not fundamental. The problem is you're competing against professional investors who have teams of analysts, advanced algorithms, and millions of dollars. You're not going to beat them by scrolling through Reddit, and you don't need to, because there's a better strategy that doesn't require you to be a stock market genius. It's called index fund investing, and it's how millionaires build wealth without spending hours researching individual companies. An index fund is a collection of stocks that tracks a market index like the S&P 500. When you buy an index fund, you're buying a tiny piece of the 500 biggest companies in America. Apple, Microsoft, Google, Amazon, Johnson & Johnson. Why does this matter? Because it gives you instant diversification. If one company tanks, you've got 499 others holding you up. You're not putting all your eggs in one basket. You're spreading risk across the entire market. And historically, the S&P 500 has averaged about 10% returns per year over the long term. Some years it's up 20%. Some years it's down 10%. But compare that to picking individual stocks. Let's say you put all your money into one tech company because it looks promising. If that company gets hit with a lawsuit, loses a major contract, or gets disrupted by a competitor, your investment could drop 50% overnight. With an index fund, that kind of catastrophic loss doesn't happen because your risk is diverse. Here's the other advantage. Index funds have low fees. When you buy individual stocks, you might pay trading fees. When you invest in actively managed funds, you're paying a fund manager to pick stocks for you. Those fees can eat 1 to 2% of your returns every year. That might not sound like much, but over 30 years, it's the difference between having $500,000. Index funds, on the other hand, have fees as low as 0.03%. You keep almost all of your returns. And since they're passively managed, meaning they just track the index instead of trying to beat it, they consistently outperform most actively managed funds over time. Even professional investors struggle to beat the market. Warren Buffett famously bet $1 million that an index fund would outperform a hedge fund over 10 years. He won. So how do you actually start? First, open a brokerage account. Fidelity, Vanguard, Charles Schwab, they're all solid options. Most of them have no account minimums and no trading fees. Once your account is open, search for an S&P 500 index fund. Popular ones include VOO, SPY, or IVV. These are called ETFs, exchange-traded fund. Let's say you start with $500. You buy shares of VOO, that's it. You now own a piece of 500 companies. You don't need to research earnings reports. You don't need to time the market. You just hold it and let it grow. Then every month you add more. Maybe it's $100, maybe it's $50. The amount doesn't matter as much as the consistency. This is called dollar cost averaging. You invest the same amount regularly, regardless of whether the market is up or down. When prices are high, your money buys fewer shares. When prices are low, your money buys more shares. Over time, this averages out your cost. and reduces the risk of investing all your money right before a market crash. Here's what this looks like in practice. Let's say you invest $200 a month into an S&P 500 index fund starting at age 25. You do this for 40 years until you're 65. Assuming an average 10% annual return, you'll have over $1.2 million. You invested $96,000 total. The other $1.1 million came from compound growth. That's the power of starting early. Now let's talk about the mistakes that kill beginner investors. Mistake number 1, trying to time the market. People wait for the perfect moment to invest. They think the market is too high, so they wait for a crash. But while they're waiting, the market keeps going up. Or they panic sell during a dip, locking in their losses. The best investors ignore short-term volatility and stay. By the time you hear about it, the smart money has already moved on. You're buying at the peak, and when it crashes, you lose big. Index funds eliminate this problem because you're not trying to pick winners. Mistake number 3, not reinvesting dividends. Many stocks and index funds pay dividends, which are cash payments to shareholders. Beginners often take that cash and spend it. Big mistake. You should reinvest those dividends to buy more shares. This accelerates your compound growth. Most brokerages let you set this up automatically. Mistake number 4, investing money you need in the short term. The stock market is volatile. If you invest money you need in 6 months and the market drops 20%, you're forced to sell at a loss. Only invest money you won't need for at least 5 years. Keep your emergency fund and short-term savings in a high-yield savings account where it's safe. Mistake number 5, getting emotional. The market will have bad days, bad weeks, bad months. If you panic and sell every time things dip, you'll never build wealth. Remember, losses aren't real until you sell. If you stay invested, the market historically recovers and goes higher. The investors who get rich are the ones who can ignore the noise and stick to their plan. So here's your action plan. Open a brokerage account this week. Fund it with whatever you can afford to invest. $100, $500, whatever. Buy an S&P 500 index fund like VOO. Set up automatic monthly contributions so you're investing consistently without having to think about it. Reinvest your dividends, and then ignore it. Check it once a quarter if you want, but don't obsess over daily fluctuation. This isn't sexy. It's not going to make you rich overnight, but it's the strategy that works. It's how everyday people become millionaires, and it's how you avoid the biggest mistake beginners make, which is thinking investing is about picking individual stocks and timing the market. It's not. It's about consistency, diversification, and time. If you do this for 20, 30, 40 years, you will build wealth. Not because you're a genius, not because you got lucky, but because you followed a proven system and stayed disciplined. That's wealth mode. If this video was helpful, please click the subscribe button and feel free to like and share with someone who is interested in leveling up their finances, just like you.